so welcome back. We're very happy today to have Yiping HUANG from Peking University to present data and collaterals. Yiping, please take it from here. You have 25 minutes.
Okay, well, first of all, I'd like to thank the organizers of this seminar series for inviting us to present this study. This obviously is a joint work with Leonardo GAMBACORTA and Chen Han from BIS, and also Zhenhua and Chen Su from Ant Group. This is a part of the research program we're doing on big tech credit, and because we involve quite a number of organizations, this is a long list of disclaimer. Basically, it's just saying these do not necessarily reflect the views of institutions like BIS and Ant Group provided data, but they did not exercise any influence on the views of the paper. So this is the basic outline of the presentation. I will try to cover 5 questions, issues: motivation and a research question, data and stylized facts, econometric strategy, results, and then I'll quickly conclude the paper. So first is basically motivation. This is these are 2 figures we took from BIS publication, which is listed at the bottom. They collect the data from various countries on the big tech credit. Here they divided the online lending into 2 types. First is the red bar essentially shows what we call fintech lending. So things like lending clubs and also Pai in China. Most of the P2P lending in China, in my understanding, would be classified as a fintech lending. So this is why, if you look at on the left-hand side, the red bar has been shrinking from 2017. That in large part was a result of declining and in fact disappearing of the P2P industry in China. The blue bar on the top, you could see is expanding quite rapidly. And on the right-hand side, you see these numbers for different countries. A simple takeaway is China is certainly one of the largest markets in this entire space. Michael also, Leonardo also told me they are at the moment updating these numbers. So data for 2020 will be available relatively soon. The idea about the big tech credit, this is a kind of a new business model. You rely on big tech platforms, a platform that has so-called long tail feature. Therefore, you are able to cover large numbers of customers. So for instance, the case we're using in this study Ant Group and Alipay, they have something like 1 billion active users on their platforms. That's a big tech platform covers a large number of people and at a very low marginal cost. And once these people are on your platform, they start to conduct some activities, whether e-commerce, social media, or searching, or anything. They leave digital footprint, and these digital footprint could be accumulated into big data and be used for a number of purposes in lending decision. So this is the ROOP, data network activities, the basic infrastructure for the big tech credit we're talking about. The key innovation here is really data can replace the collaterals. And we know for SME lending, banks adopt a number of ways to manage credit risks. And the collateral was probably one of the most common approach. You're trying to mitigate the problems of results from information asymmetry. As I mentioned, we are doing a number of studies on this issue. And one thing we looked at with some IMF colleagues last year was to compare the effectiveness or usefulness of big data supported credit risk assessment with the bank-based approach. The bank-based approach is essentially traditional data plus the scorecard model. And the big data approach mainly involves the big data and machine learning models. Our tentative result essentially suggests that for the sample, for the kind of firms or loans we looked at on the Ant Group platform, this big data approach was more effective in predicting the default rate. And the most interesting one thing we also found there was if you have, for instance, traditional data, and especially if you have data in a central bank credit registry, then you are able to make quite a reliable decision on lending. However, as we know, most of the firms borrowing from big tech credit lending, they don't have traditional complete set of data, and they're not registered in the central bank credit registry. And therefore, they often unbanked customers. And what the big data can do is to cover them, and with quite a decent result. And in fact, if you look at the NPL ratios for my bank, which is affiliated to Ant Group, and the We Bank, which is affiliated to the Tencent's WeChat, the NPL ratio roughly is around 2%, and often is below that. But you look at the NPL ratio for the SME lending loans by traditional banks, they're at least between 3 to 5%. So you see there's some effectiveness. There are many discussions there. Here we can look at why they're useful. And our own understanding is this big data supported credit risk management can deal with both ex-ante adverse selection problems and a number of exposed frictions like moral hazard problems and so on. So this appears to us, at least from what we observe in China, is a useful approach of extending loans. But I have to qualify two things from our studies, in other studies. Number one is this is useful, and this is probably more effective only when we're talking about these small loans and for the loans online. For online firms, you have connections with one way or the other, the big tech platforms. But these are very small firms, very small amount of loans, and a very short duration. The second thing is it is also very difficult for big tech credit to expand their loan size. If they want to lend more, it becomes more difficult. So in practice, we're already seeing these big tech platforms trying to cooperate with traditional banks or other institutions to combine the online big data with other forms of data in order to make a lending decision, more reliable lending decision. But anyway, for this study, we focus on the loans to the online shops and offline shops, but they all linked to big tech platform. We cover three questions here. The first question is the big tech credit and the bank credit. They probably react to a number of variables in different ways. So the ones we focus on here is the collateral value, local economic condition, and the firm-specific characteristics. We like to show how differently they respond to these variables. The second thing is related to the impact of collateral channels, because big tech credit doesn't rely on the collaterals. And so therefore, these house prices might not have an impact on lending decision. If that's the case, then the so-called the financial accelerator mechanism through collateral channel might be weakened. That's the second question we want to ask. And the third is we also want to ask if a firm is completely incorporated in the big tech system, or they only link loosely to the system if these matter when banks make, when big tech credit makes this lending decision. The story I'm talking about is here. Number one is the e-commerce shops on the e-commerce platform. So these are completely incorporated in the network. The second type of firms are these offline shops, but they use the quick response payment code, a code for payment. And they have some connections with the big tech credit platform, but they're not completely incorporated. And we also want to see if there are differences in these directions. Data and stylized facts. I guess I would just say we obtained from data from mainly My Bank. My Bank is a virtual bank affiliated to the Ant Group. We also look at some of the credit extended by banks. Therefore, we have a comparison. We select a random sample of more than 2 million firms on Ant Group's platform from January 2017 to April 2019. These lending, as I said, they mainly loans, big tech credit. But some of them also borrowed from banks before, both secured loans, which means collateralized loans, and unsecured loans. But these are, in relative terms, are relatively small. That also confirmed the point I made earlier. Most of the big tech credit borrowers are not covered by traditional banks, but some of them do. We also have online firms and offline firms, as I explained earlier on. So data-wise, we have firm level information at monthly frequency, like transaction volume, network score. These are the most important variables we will be looking at. But we also look at some of the city level data, like house price, GDP, and so on. Although GDP at the city level is only have a quarterly frequency, they don't have monthly data. So this is basically more than 2 million firms on the Ant or Alibaba's platform, and most of them borrow from big tech credit, but others, a small number borrow from the banks. And we look at these data, trying to answer the questions I raised earlier. This is just a preview of what we got, especially essentially the elasticity of credit with respect to house prices and the GDP. I guess the only variable I would focus on at the moment is the red bar. Essentially, it's elasticity of credit with respect to house prices. The one in the middle, 0.58, this is very significant. It's for secured bank credit. And I guess the easiest way to look at it is if house price increased by 10%, you could see that kind of the bank credit rise by 6%. You look at on the right-hand side, the unsecured loans, they also had some kind of positive response, but the coefficient is much smaller. And you look at the elasticity for the big tech credit on the left, it's not significant. So I guess this is just the preview or the main message we like to share with you. Econometric strategy, essentially, I'll just be quick given the time. On the left-hand side, this is a log credit, the lending, either by the big tech credit or by banks. Banks have two different forms, secured and unsecured. On the right-hand side, you have an X and a Y. X is a firm-specific variable, and Y is a city level data. And we will control some fixed effects later on. So this is basically the same model, but we're trying to control the firm-specific effects. I guess the only difference of this with the previous one is that when you control the firm-specific effects, then the time invariant firm level data like your age, your income, and so on, they would not appear in the model. Otherwise, it's the same model. We also have a model of what we call the nested model of firms with both forms of credit. The reason why we incorporated this is when we trying to compare the bank credit and the big tech credit, one of the questions raised in earlier discussion was, well, maybe you're comparing two different kinds of firms and two different kinds of credit. So what we did was we just selected a sample of firms with both borrowing from the big tech credit and from the banks. So presumably these are the same firms borrowing from different channels, and certainly we cancel that question of the fact that we might be comparing different firms. So these are the basic models we're estimating. Here, the first model.
Maybe 10 minutes remaining.
Okay. Here's the main driver of the credit. It's the baseline model I listed earlier. I guess the most important part is just to look at the shaded area on the top. And you can find the dependent variable, as I said, is a log credit. The first column is the big tech credit. The second column is the bank secured credit. And the final column is a bank unsecured credit. The top two variables, house price and the GDP. Here, I guess, as we expected, the bank secured credit respond strongly to the house prices. The bank unsecured credit also respond, but less significantly to house prices. And the big tech credit doesn't respond to the house price at all. Also, the GDP variable, you find the unsecured bank credit also responded to the local GDP to some extent. But both the bank secured credit and the big tech credit did not respond to local GDP. I guess the big tech credit is just focusing more on firm-specific variables or online variables, and the secured bank credit is focusing on more on housing prices. So GDP are not quite significant here. And then here, what we're trying to do is to control the borrower fixed effect, but we divided the lending to both online lending and offline lending. For this big tech credit, there's also a separate issue of what we call credit lines. The way the big tech credit operates slightly different from the banks. The banks, you only see a credit when the decision is made. But the online big tech credit, they can offer a credit line for a potential borrower. You can decide if you want to borrow or if you don't want to borrow. Here, we estimated the two models for both the credit used and the credit line granted by the lender. And we also distinguish the offline firms and online firms. Most of them, I guess, just confirm what we just said earlier. The interesting thing is here, the big tech credit used respond to the local GDP, and the local GDP becomes an important issue. So this raises a question if actually the lender look at the GDP here. Our answer, if we, for instance, compare the left side and the right-hand side, the right-hand side, the credit line, I guess, is just the decision made by the big tech platform, more like a supply side story. And if we compare these two, we would argue the reason why GDP becomes an important factor in the credit use on the left-hand side. It's mainly a demand side phenomenon. And in fact, you find it's only relevant for offline shops, not for online shops. The same story, we're trying to distinguish the offline, online story for secured bank credit and unsecured bank credit. Again, as I said, we control the borrower fixed effect. And essentially, you see very similar results as we showed in the baseline story. So given the time, I will rush a bit. So that's the basic findings from our analysis, but potentially there were a number of questions raised when we were discussing this analysis, mainly endogeneity problem, whether you're actually identifying the link clearly, or it is the clean relation. So just to summarize the questions raised, the first question is, if large firms respond, then, well, you could have a reverse or a way of causation. The borrowing of the firms would have a big impact on the local economic conditions like house prices and also on the GDP. Here, we're not addressing this issue mainly because these are very tiny firms and they're very, very small portion of the overall economy. And I forgot to mention earlier, big tech credit in China today is less than 2% of the aggregate credit. So we don't feel that they would have a significant impact on the local economic condition. But the second question of the characters of big tech credit users and traditional bank credit users might be different. And there are some discussions in the literature, and this is why we introduced the so-called nested model by looking at just exactly the same set of the borrowers. The third question is, well, expansion in credit may also have effects on house prices. This is kind of like endogeneity problem, whether the house price is driving credit or credit is driving the house price. We tried to use instrumental variable to distinguish that issue. And finally, there was also questions about whether or not this could be driven by more the local demand shocks. Well, the housing prices might be proxies for a number of local demand shocks related to some of the economic activities. There, we're trying to introduce some time times the borrower fixed effect and to control some of the potential problems. So here, this is the nested model. Essentially, we compared the same kind of borrowers and we got the same kind of results. I think this is a big tech credit. Oh, I'm sorry. This is a big tech credit versus bank secured lending, and this is the big tech credit versus the bank unsecured lending. The nested model, meaning we are looking at exactly the same set of firms, and the results basically remains the same. We also, as I said, use the so-called instrumental variable approach. We basically adopted two variables. Number one is lagged land supply. And we thought the land supply was in a city was determined by the city government and was probably not related to the credit supply. We also looked at the lagged land supply times the cross of interaction of lagged land supply and the mortgage rate. And see if that would have an impact on the next stage of the housing prices. The essential result here is the lagged land supply had a negative impact on local housing prices as expected. If we look at the interaction, essentially it means the land supply itself would reduce the effect of the mortgage adjustment, for instance. So that's what we did, use that the house price instrument variable to do the estimation, essentially get the same result. Finally, we're trying to control a number of fixed effect on the left-hand side, the 2 columns, and on the right-hand side, 2 columns, giving the time, and we just control different types of fixed effect, trying to control potential demand shock that were not captured by the variables we discussed earlier. So these are the basic results, and here, just to summarize 3 key findings. Number 1, big tech credit does correlate with local business, does not correlate with local business conditions and house prices, but respond quite strongly to firm characteristics. And this is the difference between a bank and a big tech credit. The second is an increased use of big tech credit could weaken the credit channel of the financial accelerator mechanism. And finally, we find the big tech credit to online firms, which are fully integrated in the e-commerce platform, is more correlated with transaction volumes and network scores than it is in the case for offline firms. I forgot to mention the network score is essentially a measure of importance of this e-commerce shop in the entire network. So if you are more important, I guess you probably will be more reliable, you will have more interactions with the others. I'll stop here. Thank you very much.
Thanks, Yiping. The discussant is Wei JIANG from Columbia University. Wei, you can take it from here.
Thank you. Thanks to the organizers for inviting me to discuss this exciting paper. I also think China right now is the most exciting place to be for fintech research. And I'm very happy to learn from this research author group that is at the forefront of this field. So let me start with the general background about this research. I think we all realize that traditional banks no longer monopolize on lending or credit provision. And tech companies increasingly provide credit to firms, especially those who operate on their platforms. And one of the key features is that there is usually no collateral required for tech credit. But this is because not only tech companies can screen borrowers based on their digital footprint on internet, but they can also utilize the same information to monitor them or enforce payments in ways that traditional banks cannot do. So the authors have amazing and unique data from my bank. And in fact, whenever I read such papers, I also admire companies like Ant Group for their willingness to promote academic research and collaborate with academic researchers. So the data set is amazing, and not only about the share volume, but it's also about match data between bank credit. So really allow us to take a look how there are differential sensitivities of different types of credit to personal characteristics as well as macro indicators. So I really enjoy reading this paper because I think research like this represents one of the most exciting new directions in finance research right now. So this is, I pretty much reprint from Professor Huang's slides. So the broad question is, can data replace collateral in credit provision? And more specifically, there are a few questions. I think it will be most helpful for myself is to go through the questions and map into the empirical tests and see what we can learn and what I would like to learn more and think the authors can do. So question 1 is reasonably straightforward. Basic ask, do big tech and bank credit react differently to collateral value, local economic conditions, and firm-specific characteristics? So I think this is the most thoroughly answered question in this paper. I only reprint one table. By no means this is the main result. In fact, Professor Huang presented multiple tests that carefully addresses endogeneity as well as borrower fixed effect, as well as for firms that have both types of credit. So we're not talking about the selection of the firm. So the interesting thing we immediately see is that there is a difference between tech credit and the bank. Basically, they put the tech puts more weight on personal or borrower information and less weight on the general macroeconomic indicators, including the housing price, which also could proxy for collateral value. There is less clear distinction between the collateral versus non-collateral. I think that the first order effect is most coming from tech versus bank rather than the existence of the collateral. So here are some of my comments. So from the data description, I believe the data, I apologize if I got it wrong, but I think that the regression samples seem to be conditional on credit granted. So mostly it's about a relationship on the credit intensive margin where supply meets demand. So from the traditional banking credit literature, the most important decision probably is on extensive margin, meaning whether to extend credit at all, because that decision is not only more important, but is also more informative about the credit scoring decision of the lender. But I think here we are mostly learn about how much credit to be granted conditional on approval. Now, then I think about it, I think maybe the application approval process is just different in the tech era, and we cannot just use the old lens from the bank to think about the same issue. Now, I suspect it could be approval is nearly 100% if you check a couple of boxes, so you're willing to provide certain certification. So it's different from the traditional bank. There's a big yes, no decision, because in the big tech, probably you start with a microcredit and you work their way up. So I think it will help for the paper to pave this way up so that we can actually learn from the intensive margin about the full decision of credit provision, which is not the case for the traditional bank credit. And I also suspect there would be subsamples when the credit rationing is very, very tight. So whatever credit supply we actually observe, we can assume that the demand is binding. So we can really trace onto the credit decision on the bank's part rather than from the demand side. So I suspect there will be a way to sort it out such subsamples, then we can get additional inference. Now, the second question is about how could increased use of big data and also machine learning, artificial intelligence could solve the asymmetric information problem, especially in lieu of collateral, will impact the collateral channel. So as I mentioned in the previous slide, I think most of the results demonstrate how the amount of credit varies with underlying characteristics or conditions that differentiate between the bank of credit. But I think so far the results do not directly speak to whether or how the tech credit will impact the collateral channel. Now, when we read about the banking literature, whenever authors try to answer whether something impacts collateral channel, I will think about the following question. For example, has the growth of tech credit reduced the demand for bank secure credit for firms that could otherwise be eligible for such credit? So this is one thing you can say, okay, impact the collateral channel. You can also think about maybe tech provided credit access to firms that want credit but will be rejected by the bank for lack of collateral. And I would think this is probably main body for the firms that actually got tech credit, but I think this could be qualified from the sample as well as for analysis. Now, a more indirect but a question that I see analyzing various data set is that now we know that certain assets, if they're good collateral, then the value of the assets would contain a premium for the value of being collateral. Now we can certainly imagine if the tech comes along and make the collateral less important, and would that shave the value premium of such assets that were otherwise good collateral? So I think these are the questions that we could answer whether something impacts collateral channel. I don't think any paper should or could answer all these questions, but it would be nice to touch on one of these issues. Now, the additional comment I have when I read the result is that I find, the results are quite fascinating. Some are intuitive, some are not what my prior is about, but I think that's a good thing because I learned so much. But I think it would be helpful to have the discussion as what the a priori predictions with respect to regression models would be. Because, for example, if data is in lieu of collateral, then we would expect tax credit behave more like bank secured debt, except without collateral. So, for example, maybe tax credit should be less stringent on age, income, local economy than unsecured bank debt, and should behave more like secured debt. So I don't think these part of results have been spelled out because results are mostly on the margin of showing the difference of tech versus bank, but could have more discussions on the unsecured versus secured debt. Basically, should the tech credit behave like secured debt except without a collateral because they have the digital prints acting effectively as the collateral. So question 3 of the stated objective, that are these differences between credit granted to firms that operate online versus offline. So again, I think this table, I think differences manifest themselves most in credit demand because that's credit use rather than credit supply. So I think most of the papers are about credit supply. But this one actually shed light on the credit demand. So I think this part could be played up because otherwise in other parts, we couldn't really see the demand. And this is precisely the strength of the data we can track in real time about actual credit use, which such data is usually not available for the banking credit research. Now, let's get back to the big question. So can data replace collateral? So we learned more about the determinants of credit granting, separately for tech and bank, separately for online and offline. I think so far they're still mostly about data-driven credit scoring versus the traditional methods. But I clearly see the paper has huge potential to go further on really answering the question about the substitutability between data collateral in order to answer the title or the headline question. Now, one thing I would like to elaborate a little bit is that the differential sensitivity with respect to signals could be due to either the different decision rule or just the different observability, and that could mean quite different things. So let me give you one example. So for example, if income credit score is observed for both secured and unsecured lenders, but secured lenders just put less weight on them because after all, they can seize the collateral. So this information is on the same footing, but the decision rule is different. While the second one is about information different sufficiency rule. So perhaps both tech and bank would like to use real-time network information to the same extent. I'm just pointing out a counterfactual. Now, however, the bank would not be able to observe like the network information or the real-time volume of payment as timely or the same granular level as the platform operating tech. So as a result, they need to weigh on coarser signals about the same fundamental information, which is about individual credit quality, such as local economic condition. So they're relying on local economic conditions, not because the decision rule is different, but they just need to resort on a coarser signal about individual credit quality when they don't observe the real-time digital footprint. While the tech credit providers would observe information signals that are sufficient for the local macroeconomic conditions. So I think these means quite different economic insights, and they're each interesting on their own. And I think will be very, very interesting if the data or the empirical test would allow us to say which one is more important. It could be both. And the other dichotomy is the information asymmetry versus moral hazard. I think Professor Huang discussed a lot in the introduction. That's showing the digital footprint could be used for screening or could be used ex post enforcement of the debt obligations. But it would be nice to be reflected or connected to the empirical test to say which tests speak more about information asymmetry, which speak more about moral hazard. Especially if there's data on the ex-post performance, then much of the second part could be made more informative. So the last one is that I'd like to connect to a couple of very, very new papers. So if I spell out the paper, it's because the paper currently has not been referenced. But all these papers are 2020, 2021 paper, I only learned about very recently. So despite this be such a new area, I'm just so amazed by how quickly the papers in these related topic areas are coming along. Now, the first papers by Dai et al. So they, as the title suggests, they are talking about how digital footprints could serve as collateral, and they are focusing on ex-post enforcement and less about ex-ante screening. So basically, what they show is that knowing the address or the type of transactions that the borrower makes will really facilitate the debt collection, even in the absence of the collateral. And in this analysis, I can see a more direct connection how the digital footprints literally take the position of collateral in analyzing delinquency and recovery. Now, the second paper by Jiao and co-author, it's a very, very nice theoretical work. Basically show in the end, borrower data could be shared between bank and fintech lenders. And it seems it is exactly the setting of the data that Professor Huang and his co-authors are working on. But the theory paper also showed the extent of the sharing is endogenous. And I think the fact that the bank could observe at the lag or with some filtering about what the fintech lenders observe, I also feel that part can draw a lot from this the theory work. Now, the Berg and Tong work and Tong work already cited in the paper. So I think the authors discuss about I think the authors focus on the substitutability factor, but certainly, both these two papers pointed out that it could be both complementary or as well as substitutive. And finally, there's another new paper by DiMaggio and Jiao, and they actually integrate both screening and ex-post performance. So, and I would not be surprised this author group can also get data about ex-post performance, which will really, really make the analysis more powerful because you can integrate the effectiveness of their screening to the ex-post performance. Okay, so I think I'll stop here. I was very excited to read paper, and I always enjoy reading paper in this topic area about how big data is rewriting the rules we think about credit access and credit scoring, as well as the impact of credit quality. And also, I also like to see the paper to shed light on the evolving nature of information asymmetry, because in the traditional credit literature, we always think borrower knows more about themselves than the lender. But in the digital footprint, one can also argue, actually, the lender, I think, Google knows more about me than I know about myself. So the lender actually know a lot about the borrower than the borrower can actually put into one place. So the nature of the information asymmetry is quite different between the tech credit versus the bank credit. So in summary, the paper offers tons of interesting results on credit scoring. And I really would like to see the paper to realize the potential to also address the credit access performance and how these elements are really, really related to collateral, both in screening and enforcement, as the headline of the paper would suggest. And I guess that is the ambition of the authors. So thank you so much. I think I'll stop here. Thank you.
Today we have plenty of time for discussions. So anyone from the panel wanted to? Oh.
Can I ask a question first?
No, go ahead.
So, Yiping, I want to know more about the interest rate say that how those interest rates are responding to individual characteristics. And in particular, when I think about the substitutability between fintech lending and big tech lending and traditional banking, and then is it true that when there is a competition between, say, traditional banking and big tech lending, then the response of interest rate will be a bit more subtle, in a way that you can see whether or not this big tech lending is in a monopoly, or it's competing with local banking, traditional banking. Thank you.
Should I respond or should I wait?
Oh, go ahead.
I'll just on the interest rate, it's slightly different story for interest rate for the banks for a couple of reasons. I guess the main reason is because big tech lenders, even like my bank, it has a bank license, but it doesn't have appropriate deposit account because we still do not allow remote opening of banking account. So in other words, my bank, we bank, do not have proper bank deposits like all other traditional banks have. So they have to find the funding from elsewhere, like ABS or their own money or something else. And as a result, for reasons I don't exactly know, the interest rate is kind of more liberalized for these virtual banks than for traditional banks. So for instance, if you're lending for if you're lending by traditional banks for SMEs, you can only float up the flexibility range for your lending rate is quite limited. For instance, if LPR is 4%, you're probably able to add a 2% percentage point, or maybe maximum of 3 percentage point. In fact, every year, the regulators are forcing them to lower the lending rate. So these are highly regulated. For big tech credit, the lending rate is much higher. I think it's slightly below 10%, but I think one reason is because their cost of funding is higher, but also because their lending is more for smaller amount and a short duration, like 3 months and so on. The regulators sometimes want to discuss with them to see if they could push the lending rate lower. I also discussed with the president of my bank and asking them if they could further lower it. They said that they could try, but the room for further lowering lending rate is quite limited, mainly because data and analysis, they're also quite costly. So at the moment, it's significantly higher than the average lending rate.
So you're using only the amount of credit as your observable. Is it because you only observe the amount of credit? You don't observe interest rate, the duration of the maturity of the loans?
No, we have.
So how come you're not using that piece of information? I feel like
duration is here. Well, the reason why we did not use duration is we want to use a kind of lending the same, similar or the same as the bank. So for instance, 1 year lending. I think we had some troubles in using the lending rate explicitly in our exercise. I think the bank was quite nervous.
I see. So follow up on Michael's question, is it the case that only a borrower cannot lend from the banks? That borrower will approach my bank? Well,
it in general is the case. If you can borrow from the bank at 6%, why would you borrow from a big tech credit lender? But the other thing is, it's also quite interesting. There was an article circulating in social media a few months ago explaining why these shops are borrowing at 10% from the big tech lenders, not from the banks, because the procedure is so much more complicated. for the big tech lender, you already have a credit line on your mobile phone. I visited a number of borrowers. They said they were not satisfied with the size of the loans, but they still use it quite frequently because you could walk out, and if you want to buy some goods, you can just pull out your mobile phone and you can do it. Plus, the lending rate sounds high, as I mentioned, but if you're borrowing 5,000 yuan, and even if the lending rate is 10% and you're using for 1 month, it's like 50 yuan, and to them it's nothing. They don't really worry about it. But if you go to a bank, if you want to, for instance, borrow, I don't think they will talk to you if you want to borrow 5,000 yuan. They probably will be not interested if you want to borrow 50,000 yuan, and they probably will say you have to borrow for 1 year. So in that case, the transaction cost is much higher. The actual cost, the financial cost might also be higher if you have to hold that loan for 1 year. Here, the lending rate sounds quite high, but if you can just use money for 1 month or 3 months, the cost is actually lower. That in terms of amount of money is actually lower.
I'm just curious, do you also have the default rate for these loans?
Yeah, as I mentioned, the default rate was below 2%. We look at the entire sample, look at, for instance, what happened last year during the pandemic. The default rate went up to somewhere around 2.2%. But from July and August, the rate start to come down. They were able to react to the condition much more quickly than the banks. The bank's rate, well, I don't know the exact numbers, but we're seeing recently the rate is high. But as I said, the average NPL ratio is much lower in these banks than, for instance, the average NPL ratio for SME loan by banks is 3.5%. But if you look at the loans, smaller than 5 million per loan, the average NPL ratio was a 5.3 or 5.5%. So I think Wei made a very good point earlier on. Screening is one thing, but also I think managing the moral hazard problem, monitoring was also a big part of the story.
Thank you for Yiping for a really wonderful paper, and thank you, Wei, for a great discussion. I want to ask the following question. The title is, you can hear me, right?
Yeah, very clearly.
The title is Data and Collateral. We know that we are talking about really two different products and two different kinds of behavior, as you already just said. The volume is different, the duration is different, and so accordingly, there exists difference in transactions cost and so on and so forth. So this doesn't mean that you are addressing the substitution between data and collateral. So I want to move towards Zhang Wei's point. Suppose, let's say I go to the bank, and whether I ask for a mortgage or not, the bank will give me an OD line, and very small and high interest rate, and so on. But let's say if I want to ask a big one, I have to mortgage my house. Then I want to ask this question: with more disclosure of my information, or allowing the bank, to observe all my day-to-day transactions in my business and so on and so forth, does that change the terms of my big loan?
I'm not sure if I understood your last bit of your question.
I'm looking at the same firm.
Yeah.
The same amount of loan, big. Okay, there may be a bit of collateral and so on and so forth. But in one case, the bank would have ability to monitor the firm's account payable, account receivable, sales, and so on. The other one, no. Now this one, of course, there is the moral hazard and those kind of problems, signaling problem that Zhang Wei suggested that we need to pay attention to. But is there some way to subsume that and just look at how more disclosure, timely disclosure, or monitoring of business transactions allow the bank to give me a more favorable term. That is where the substitution between data and collateral is about.
This is in part, it could be the story. I think if credit risk assessment is essentially about the information asymmetry, then the question about what you're relying on is to reduce information asymmetry. If you have ways of helping with reducing that problem, I think it will be very useful. So I think also related to Professor Jiang Wei's comment, whether data is exactly replacing the substitute for collaterals. I guess the substitute or replace, the way we're saying, is more like traditional banks have to rely more on the collaterals to make a decision, to control the risk. Here, we are using data, but the data could work in different ways. Like to some extent, that's my understanding, might not represent my co-author's view. The big data analysis could also be similar to the traditional relationship banking. You know the borrower better, and you're able to lend even without the collaterals. In a way, this is also what we mean by replace or versus lending. Bernie's question about if you disclose more information, would that make it easier for the lender to make the decision?
Well,
yes,
more than disclose, I allow the bank to observe my behavior all the time.
Yeah, all the time, whichever. I give you an example. This is slightly different, but I think it answers the same question. For instance, in China, the big data at the moment are mainly owned by big tech companies. The sharing is actually a very complicated story. The government is trying to push them to share data. I'm less positive about this. But in other areas, they're doing it. For instance, some local government is setting up what they call financial information platform for the banks and the borrowers to come onto the same platform. But that platform would link connected to all other data information like your tax payment, the social security, the legal lawsuit, and so on. Once the borrower get onto the platform and send an application, the platform match them with a potential bank. The bank can, under the authorization of the potential borrower, to search for these data and make a decision. This is actually working pretty well for many banks without a big tech platform. So I didn't answer your exact question, but I'm just saying more information for the banks would definitely be helpful for making good lending decisions.
Can you compile evidence on that, systematic evidence on that?
What do you mean evidence?
And just do another paper.
Yeah, no, definitely.
I guess data on this government-led small platform. That sounds like interesting.
Yeah.
These are more government, but
initiative.
also some like something like you're paying the electricity, water, and so on.
Yeah.
So whatever data are there, if you can connect, and then you make a good decision. Zhejiang, well, there are many local governments doing it. I think the best one, I visited many times, is the one in Zhejiang province. Maybe we can do a joint paper.
Can I ask perhaps the last question given time? So you mentioned as well as Jiang Wei, also we knew that the China story or Ali story basically is a slightly different thing. It's just such a unique combination of all these details make it that thing work pretty well,
right,
to be honest.
Right.
Now, if you look around, not just think about like, let's say US or Europe, just think about other parts of the Asia, let's say India, right?
Yeah.
What do you think, can they do this? Like, you know, getting the data and then immediately get send, like just extend the loan without worrying about like, you know, default, right, just go away. We call it absconding or whatever, like, this is why that we need a collateral, right? That's like, right, we need something hold on you, right, or footprint to collect. So all these things seems to be not that much for the Ali's case.
Yeah.
But do you think that's replicable to other parts of the?
I definitely think it's replicable. The only condition is that you have a bigger data, bigger tech platform. Therefore, people do something on your platform. Ali's case is e-commerce and a mobile payment. But the WeChat, Tencent is exactly doing the same story. However, they focus a bit more on the social media interaction. Some people say social media data is actually more complete than the Alipay and e-commerce, because your social media is essentially your entire social network. And it's better for making a judgment on your lending decision. India, you just mentioned, for instance, Paytm is already doing the same business. In many other countries, they're all doing the same business. But I guess what I would say is, number one, you do need a big tech company. Now, sometimes it doesn't matter if you really focus on, like, it's built on search engine, social media, short video, e-commerce, mobile payment. But the question about the bigger data is that you have a circle. They can try to analyze you from different angles. That's the first thing. So meaning you have the loop I mentioned earlier on, data, network, and activity. Then you need analytical skills. And I can tell you, some of these big tech lenders, when they started a business, their default rate was quite high. So it took quite some time for them to improve their model, try, and so on. Gradually, they start to improve. So analytical skill, combining the big data analysis and the financial logic, is also very important. Quite a number of lenders had bigger problems because they didn't understand finance, but they think they can use this data just to do it. The third thing, I think is also very important, is especially regulation. I think the regulation is different. In China, somehow there was no strict restriction on these activities, but now they're trying to bring full coverage of the regulation. So my answer to your question is, my understanding is, I think it's quite possible to replicate, as long as you have the things I just listed. Maybe I should respond to Professor Jiang Wei's comment. I won't be able to address all these questions one by one. I mean, I certainly should like to thank you for your very detailed comments, and these actually open up a number of doors, not just to improve the paper, but some of them could be very useful to write new papers. So for instance, one question you raised, you mentioned a couple of times, whether or not we're able to distinguish the function of the big data in terms of resolving the adverse selection problem or the ex post, the moral hazard problem, verification problem, and so on. We are thinking of doing it in a separate paper. Maybe this will be a bit too much here, and that is a little bit more complicated. So that's one thing we're doing. The other thing you also mentioned in this paper, we didn't discuss enough about the question about the decision making, how they decide and what kind of decisions they made. As I also mentioned, we essentially followed the Burke paper on using the 8 digital footprint variable in assessing the credit risk. We did a similar paper last year with some IMF colleagues using and group data and trying to see how they make these decisions and how do they fare after the decision. The bigger question I think you mentioned really is the fundamental question of the relationship between data and the collaterals, and how can we trying to dive down to explain more satisfactorily the relationship. So especially on the second question and the third question, I will discuss with my co-authors later. I won't be able to answer all of your questions, but I really appreciate, and I think it is very useful for us to improve and to add some more materials on the questions. But I also think these also give us opportunities to do more studies. Thank you very much.
Yiping, thanks. Actually, you're not off the hook yet because there are more questions online. So let me read out one question from Wei JIANG from MIT. He says, my understanding is that the capital behind the big tech lending also comes from banks. Is there any evidence that the sensitivity of these two types of credit supply to large aggregate shocks? So is there any evidence that these sensitivity are significantly different? For example, would banks cut the supply of would cut the supply more than the other?
Well, at the moment we don't have. At the moment we don't have evidence yet, but some money of the big tech credit is from the banks, especially last year. My bank collaborated with more than 100 banks. And I think it works in both ways. Big tech, my bank, as I mentioned earlier, they didn't have enough funds. Therefore, they need some finance money from other sources. One way is to issue ABS, but the other way is to collaborate with the traditional banks. The traditional banks have some, especially the smaller ones, rural commercial banks, city commercial banks, and so on. They have some borrowers, but they have some deposit, but they don't have enough borrowers. And sometimes they don't know how to make the lending decision. That's why they can't lend. So in collaborating with the big lenders, they're doing better jobs. Another point I also mentioned earlier on, that my bank collaborated with the traditional banks, not just because they are short in fund, but they also want to take advantage of the offline data. These are also very useful for making loan decisions. I mentioned, as I said, these big data credit risk assessment model won't be applicable to any other kind of lending. It's just quite specific for specific borrowers. So for these different banks, the responses that we saw, I think if we are talking about the bank lending and the big tech credit lending, then the distinction is still quite clear. If money from bank through the big tech lender to lend the money, I think the behavior still is more like a big tech credit. But the question now is that we actually don't know exactly how it is going to evolve. This is a very dynamic. Regulators want to form a new way of cooperation between the banks and the big tech credit. So it's changing quite rapidly.
Thanks. To follow up on that response, you said this is a very fluid situation. So I read from the news that according to Financial Times, the regulators are going to create a separate kind of a joint credit scoring joint venture, and yes. State-owned business will have a significant stake, and the banks will no longer have their access, monopoly access to the data. So your data as collateral is going to be broken up.
Well, not really. Here, I'm probably walking into a little bit of sensitive area. The new direction of policy is that the government encourages set up of this new credit reporting system business based on big data. So far, it didn't really work well. There was one in Shenzhen by Hang Zhongxing. They're still doing it, and I hope they will do well in the future, but they're still not working very, very well. There are two issues there. Number one is when you form a new company in Shenzhen, it's dominated by a state-owned company, and all tech companies each had 8% of the share. There was a question about the incentive to contribute to their data. I think that's a big problem they're facing. The second question is once data leaving the big tech platform, whether they will still be equally useful. And I think this is related to the question we discussing earlier. Data is useful for you to make an analysis, but this analysis has to be very dynamic and continuous. It's not like a credit registry information. You look at one data, you make a decision, like not like a FICO, right? So I'm not sure if that works, but also the fact that they only allow the big tech company to own a very small share. The incentive for them to contribute to data and analysis is very limited. But anyway, gradually they're changing. I think that the future idea is maybe some of the tech companies can play greater roles in forming these new credit registry company. I also read from news, for instance, Ant Group is also forming a new company with a local SOE, but Ant Group will probably have more managerial roles in running the company. The regulator's idea is that the new business model should be the tech company collaborate through with some the big tech credit registry company in the middle and linking to the bank. So there should be no direct link between bank and the big tech company. This new business model is still to be tested. We don't know if it exactly will work, but you can see the reason why the regulators doing it. Their worry is that if the banks are collaborating with the tech companies know some tech data, but they don't have a full responsibility for the results, the consequence of the lending, there might be some new issues. But this, whether or not this will work, I don't know. My own worry is that if you don't give the tech companies enough incentives, and if you don't integrate that decision-making process into the big tech process, the root I mentioned earlier on, that data, network, and activities, these should be in the same process when you make the lending decision. So I think these two things we still need to be cleared.
Thanks. That's very helpful. Thanks.
Thank you.
So I think our time is almost up. Do we have more questions?
Well, feel free to send me emails if you receive more questions, and please forward to me. I'm very happy to address them. I mean, I would not be able to answer all the questions, but this is an area we've been working on. And we also would very much welcome collaboration if other economists are also interested.
Well, I want to thank everyone. Thank you, Pengjun, for really wonderful sharing, and Yiping and Jiang Wei. Thank you very much. I'm learning a lot from both of you and also from the audience. Thank you very much. And we look forward to October 14th. There will be a paper on Chinese retail investors, and Xiaoyan and her co-authors, Charles et al., will be presenting the paper. So I look forward to seeing you all on the 14th of October. Thank you very much.
Thank you. Bye-bye.
Thanks.